Hey everybody, I wanted to get started here, but while people are logging in, we will get some of the shameless advertising out of the way. How about that? So fpfeaz.org, that's the website. If you don't know about it yet, that's the nonprofit organization that I run here in Arizona. Again, it's fpfeaz.org. That's Foundation for Personal Financial Education. This is the Arizona chapter, but I do broadcast all over now. So you can find our class schedule on here. We have got a whole bunch of different opportunities to watch every class. We do have a couple of in-person locations, and then all of our Zoom classes as well. So jump on there. You can register for classes. You can see all the upcoming topics on there as well. We do have a great little on-demand section that we put some interesting stuff in. I was able to work with the Social Security Administration directly and create some videos with them. And then we always put the class of the month on there as well. So fpfeaz.org is a great resource for you. Jump on there. If you have not found our YouTube channel, we have a full channel. It's called Planning Before Investing, and we have over 300 videos on here. Everything I can think of, I made anywhere from 10 to 20-minute type videos on every topic I can come up with. If you click on videos, you can even search them. So if you want a video on required distributions, you can search that. Or taxes in retirement, or any of these topics, it's a great resource. You can find wonderful videos on there. And then certainly, if you want to meet with me or find out more information about my company, sesweb.net, sesweb.net is our website. You can click on the appointments tab and schedule a free meet and greet with me if you'd like. But also under the education tab, we finally got the go ahead to put all of our recorded classes on there as well. And so as we teach new classes, I update those classes on this as well. So feel free to jump on there and watch some of the old classes, and certainly reach out if I can help in any way. Always love to meet people wherever you are. All right, so that's the shameless advertising. Let's jump into this month's topic. Last month, it was all the information you needed to know about taxation in retirement. This month is how to start applying it to your situation. And those that know me, I'm pretty passionate about making people as efficient as they can be with their situation. And that's what's so important to understand is everybody's in a different situation. So crafting this class became very difficult. I always have to make sure that I'm making this as useful as I can for as many people as possible. So some of this stuff's going to apply to you, some of it's not. It's important that you work with CPAs or financial advisors that understand what they're doing, and figure out how to apply this to your own situation. So my background, well, again, the nonprofit organization, the whole idea of it is to be able to provide this financial education without the biases and sales that you get in all those wonderful dinner seminars. So I want really to combat that type of information, the sales information that has the biases and the spins and the tactics in it. This is all for just good, clean information. Hopefully you find this to be a better atmosphere and keep coming back for more. We have different topics every month. As I've said, we even have a YouTube channel with another 300 videos you can view. I've been running the nonprofit for over 10 years now. It's probably more like 15 at this point. The master's degree I have came from University of Arizona. It was focused in finance, CFP, Certified Financial Planner from Pepperdine University. And then I own a local family of companies that includes a wealth management firm and a tax firm. I say local, I have clients all over the world now, which is pretty fantastic. The great thing is Zoom has connected us all for sure. So always happy to help out. I do have practical working experience in virtually everything that we do, and happy to do a meet and greet and discuss if I can help in any way. And then there's the legal disclaimer. Please understand that this is for educational purposes only. I'm not speaking directly to you. I'm not giving you exact advice for you and your situation. So use those CPAs, financial advisors, attorneys, whoever it is you need to help apply this type of stuff to your situation. And if you don't have them, I'm always available. All right. Oh, before we get too far, understand if you need a copy of or a link to the recording of the video or things like that, there'll be a brief survey at the end. You can reach out to us via that survey and we'll get you what you need. All right. So, goal of today's class, it's becoming tax efficient, right? It's just I need you to pay the amount you have to pay, not more, not tax evasion, not less. I need you to pay no more than you have to. How's that? That's really what everybody's goal. So lower your tax burden today and tomorrow, maximize the amount of money that stays in your pocket, and maximize the amount of money that passes to your heirs. So this is about becoming tax efficient going forward. I can't fix the past. I mean, if you made an error on a tax return, okay, fine, I can fix the past. But the reality is this is not about fixing the past. What's done is done. We got to work on what's more efficient for you going forward so you pay less taxes. So, the agenda, we're going to start out with why. I'm going to give you some brief examples as to some things that I've seen that are just drastic. And yes, I've made them a little more drastic so you can see the point. And we'll go through those, each of those one at a time. Um, then, positioning your savings, creating an income plan, controlling the flow, year-end maintenance, talking about your heirs, all these kinds of things. We really need to make sure that we understand a lot of these because this is what affects most people, and becoming efficient in all of these situations is really what we're looking to do. All right, so let's start with why. Here, let's show you some common scenarios. I actually ran into this one, and this was one of the reasons I started providing tax advice. I went out and started a tax firm. I got CPAs. I got myself the ability, the education to do this. This was very early on in my career. I ran into a lady. She was 80 something years old, and she was complaining to me some years she pays a whole bunch of taxes and some years she pays none, and she was living on such a tight budget. It really made a huge difference when she got surprised with a $3,000-4,000 bill for taxes at the end of the year, and she couldn't understand why. So when we look at her scenario, she had 17,000 in Social Security, 16,000 pension, and she had $9,500 1099 showing up with a bunch of dividends and short-term capital gains. And just you could tell it was mutual funds, and she wasn't using any of that money. And she looked at me and said, this money is either going to help pay for my long-term care or it's going to my son. I am not using it. I am living on a tight budget. I refuse to use this money for my retirement. And so that was just her mentality. She didn't do much in retirement. She couldn't do much in retirement. She didn't have a huge amount of income. So when I did the Social Security calculation, this is the estimator as to whether you're going to pay taxes on your Social Security or not. It's half your Social Security. It's all of this pension. And yes, even though these dividends are being reinvested, it is all of these taxable events that happened from a mutual fund she never sold. Okay. Adding all that up, it added to 34,000. Well, the IRS and Social Security Administration provide a chart, and once you're a single person hitting 34,000 on this calculation, it says you're going to owe taxes on 85% of your Social Security. So she took home $33,000, right? So she took home the Social Security and the pension. Okay, that's $33,000. But she paid taxes on 39,000 because all of this mutual fund dividends and churning that goes on inside the mutual funds. She had to pay taxes on more money than she actually received. Okay, so she owed about $2,500 in taxes that year, and this was just the quick, easy analysis of her situation. And the funny thing is I asked her, well, who's managing this stock portfolio? Do they know what's going on? And she looked at me baffled and said, honestly, I don't think I've talked to them in over 40 years. This money's just been sitting there. Well, it sits there in mutual funds. Somebody's pulling their fees off of there and not paying attention to anything. And in this particular year, that 1099 was a little bigger than it normally is. And that's what kicked in the Social Security taxation. So by adjusting it to a portfolio that doesn't kick it out, maybe an ETF instead of a mutual fund, moving to tax deferred, tax free, tax advantaged. Literally, there's thousands of choices that don't kick out $9,500 in uncontrollable taxable events, and I didn't even need that money. So the reality is there's lots of different ways to invest it. So adjusting the portfolio becomes prudent because now all of a sudden we're controlling the taxation in this portfolio, and she didn't owe any taxes on her Social Security. And well, that meant she owed no taxes at all because the standard deduction took over that pension pretty easily. So that saved her $2,500 in taxes and answered the question as to why some years she pays a bunch and some years she pays nothing. It's because of the taxation in the rest of the portfolio. The investments that she chose were unpredictable on the taxation, and it caused the taxation of her Social Security in some years. So that's a kind of a showing you a microcosm of the effect that happens in those portfolios. This one I ran into much more recently. This has been happening quite often, unfortunately. So here's an example of what's going to happen when you pass away with your IRA. So I had some kids come in and one chose to cash out the IRA and go buy a new Corvette, and the other one wanted to do it wisely. So I couldn't convince the Corvette buyer to do anything smart, so they just paid all the taxes all at once. So their share was 500,000. They each got 500,000 of this IRA. So 500,000 in the good clients, the good kids scenario, she was married and total W-2 income was 100,000 for the household. So the brother, let's just say the brother chose the lump sum. Give me all my money. I'm going to go spend it. So yeah, his tax bill was about 130,000 on the $500,000 IRA. So that was the choice. 100,000 worth of income. You add 500,000 to that, you jump way up into the higher taxation immediately, and you're paying huge amount of taxes all at once. And those of you that understand taxation, especially from last month's class, choosing one big huge lump sum, that is not good. That's higher percentage in taxation. So really, he only inherited $370,000 as opposed to the 500. We've got the married W-2 for the daughter, the good daughter that said, let's talk about this. Let's figure out the best path, because there are rules when you inherit IRA money. And so how does this work? So that becomes the most important part. So we look at this and say, okay, well, we got a 10-year distribution. Worst case scenario, we are in a situation where we could do equal distributions for 10 years. So in this scenario, just easy math, 50,000 every year. We get that money dispersed, and that reduces the taxation. So instead of 600,000 in one year, we're only doing 150,000 a year for 10 years, right? That reduces the taxation on this IRA money, okay, to 83,000. That saved almost $50,000 in taxes. That's a success as far as I'm concerned. We have to get this IRA money out in their scenario in 10 years. You take 1/10 of it every single year and get it all distributed in the 10 years. But the important part in this case was this money was going to enable them to retire a little bit earlier than they anticipated. So they're thinking, okay, I'm going to work about 5 more years and then we're going to retire and live off some of this money and to use it to bridge the gap to Social Security. So in their scenario, we started playing with the idea of, okay, well, great, let's not touch it for the first 5 years. And then let's pull out 1/5 as opposed to 1/10. Let's pull out 100 grand a year. And yes, hopefully we invest it, we grow it, and got to pull out more. I get it, but we're keeping the math simple. And so instead of touching it in the first 5 years, we're going to pull it all out in the 5 to 10 years. Okay. And we're going to do that because they have no income because they quit their jobs and they retired. So zero for the first 5 years, and then a much faster withdrawal rate, 10 or 100,000 a year for the next 5 years. And that, because we eliminated the W-2 income, reduced the taxation to only $39,000 in their scenario. So instead of inheriting 500,000, they actually inherited 400 and say 60,000, whereas the son only got 370,000. That's a big difference, and that's an enormous amount of savings. And so everybody's got a different scenario and is trying to figure out what's going to be best for them. And that's why help for your heirs. If they're going to inherit a big pile of IRA money, it's good that they're going to have some help because there's different rules for different situations. And this makes an enormous difference. We're talking $90,000 in taxes, $91,000 in taxes different between the brother and the daughter. That's an enormous difference there. So this is what we mean by being as efficient as we can with your situation. It's very specific to you. And we've got to learn these things. So the basics we should have learned last month. Hopefully you attended that class. If not, go to sesweb.net and watch the old class, last month's class. All right. So positioning your savings is one of the most important things that we have to start with when it comes to trying to be as efficient as possible. So when we look at positioning your savings, the first thing we have to talk about is your inventory. Okay, everybody's going to have different inventory, and we're going to start with this 3 different types of money, as I like to call it. Your IRA savings, pre-tax, money you haven't paid taxes on. Your Roth savings, that's all money that's going to be tax-free going forward. Your NQ stands for non-qualified. This might be your brokerage account, your CDs at your bank. This is your money that is not Roth money, that is not IRA money. So all of that money that's invested, I put in that category. And then yes, we can say we've got equity too in the house. So if you have multiple rental properties, you have second homes, you have all those kinds of things, how much equity do we have in real estate? I like to add that one on in this case. Okay, so that's the first part of the inventory. Then I want you to sit down and look at all this money and say, well, what do you consider safe and stable? How much of this and how much of this is risk-based? How much is it in the stock market versus bonds are somewhere in between? Not exactly safe, but maybe more stable. I'm fine with that. Okay, CDs, the annuity world, that kind of stuff. So safe and stable investments and how much is in risk-based investments. Then I want you to add up your guaranteed income. How much Social Security, pension, how much money do you have coming in on a monthly basis? Interest from a CD is not guaranteed. It's only your pension income, your Social Security income, maybe an income annuity that you triggered that's giving you a lifetime payment. I'll accept all 3 of those as guaranteed income. Then I want you to do your own little budgeting. Okay, how much is survival? On a monthly basis, in terms of bills to survive, keep the lights on in the house, keep the shelter over your head, keep yourself fed. So your grocery bills, maybe your Netflix and internet bill, just the basics, okay? And then estimate how much fun money you need each year, right? How much traveling, what do your hobbies cost you, things like that. You go out to the movies all the time, you go out to dinner all the time. Those are the I wants, okay? So how much ideally is the I want budget? This is the I need budget. This is the I want budget. Okay, we're all adults. We know the difference between wants and needs. All right, you add those 2 together. That is your ideal income in retirement. That's how simple it should be. We do this on purpose. Simplicity makes things easier for everyone. All right, if you're an engineer watching this, I don't need pennies. No pennies. Round it to the nearest 1,000 and round it up because we want things rounded up. It's much better that way. All right. Difference between each of these tax classes. Okay, this is so important. Now we've got our inventory. We do that inventory. We write all those numbers down. We got all that laid out. Now we got to know that there's different rules for different parts of our portfolio, right? So we look at IRA money and we say, okay, no matter what we do in there, it's always going to be taxed as ordinary income, the highest taxation, okay? We're always going to pay full taxation every time we pull a dollar out. It doesn't matter what we invest in. It doesn't matter whether we're buying and selling. It's only when we pull the money out. So the rules are going to state at some point we have to pull money out. We don't have a choice. And the less IRA money we have, the less they're going to force us to take out. The more we can control, right? So the control part of this comes from reducing the amount of IRA money you have before you get to those forced withdrawals called required minimum distributions. So because of that, once you retire, you must look at that money every single year and figure out how to get it out at the least amount of taxation, followed by those required minimum distributions. Too many people just sit on their hands, don't look at that money. I can't touch it until I'm forced to pull it out. That's not a good way to handle this when it comes to taxation. That's not going to be efficient. Proactive people end up paying a lot less taxes on this money. Okay, this is your heirs' least favorite money, and because of all the rule changes on what the heirs have and have not in terms of what they're supposed to do, it's getting very messy out there, and they're getting very bad advice from the advisors that just read the answer from their computer screen, because the answers come out different because we have different rules for different years that the people passed away, all these kinds of things. It's a mess. So a good advisor needs to be able to look at this, understanding the rules, and figure out what's going to be best for your kids. No such thing as tax-exempt interest, no such thing as long-term capital gains or qualified dividends. There's no tax-advantaged investments you could do. You could buy anything, though. You could buy gold, you could buy a house, you could buy a racehorse, you could buy any investment you want. So we have to understand that everything you invest in there will be taxed in full taxation when you reach in and take the money out to spend it. You can buy and sell and buy and sell and do everything you want inside, nothing happens. So it doesn't matter whether the earnings are interest, doesn't matter if they're losses, it doesn't matter because you've never paid taxes on it, and it will all be taxed the same when it comes out. Okay? Roth money. This is your heir's favorite money, right? They get to inherit this, and most of them will get it for 10 years, let it sit there and grow. And then at the end of the 10 years, they can then pull it all out tax-free. Okay? So Roth, everything is tax-free. As long as you follow the rules, that was my January class. You can learn all about Roth and using it properly in my January class. Growth or income with no tax consequences. That's the only benefit of this. If you don't grow at all, there's not really any benefit to Roth, right? So growth and or income with no tax consequences. Some investments that are not great in your after-tax portfolio can be great here if you're trying to create yield. Publicly traded REITs, MLPs, closed-end funds, these are all typically very bad on taxation. Well, in Roth, there's no tax consequences. Doesn't matter how you invest when you pull it out, as long as you followed the basic rules, it's all tax-free when it comes out. All right, no required minimum distributions at this point either. Now, after-tax money, all this other money, maybe it's your trust money or your brokerage account, CDs, whatever it is that's not IRA and not Roth, all this other money. We call this non-qualified money or after-tax money. Each investing choice comes with different tax consequences. This is where it becomes difficult, okay? So when I look at this section here, move me out of the way there. Avoiding interest, non-qualified dividends, and short-term capital gains is essential. That's right. Avoid interest. Don't purposely put a whole bunch of CDs in here. CDs have been rendered useless because there's much better investment options. Next month's class talks about all the safe, stable investing options that are out there. Try to avoid corporate bonds that pay interest. That's same thing as earning interest on CDs. There are plenty of other ways to invest this money. Okay. The other side of this is when you invest in equities and real estate, the cost basis steps up upon your passing. So if you bought a stock for $5 and it rocketed to thousands of dollars, you wouldn't have to pay any taxes on those gains if you passed away before you sold it. There's advantages to the stock market investing here. Qualified dividends and long-term capital gains are taxed at much lower tax rates, as we learned in the previous class. This is where we can have these tax advantages, and that's where it's important that we understand our investing choices. If we buy mutual funds here, you're not going to be able to control the taxation, just like that lady in my example. Okay. Whereas if we buy an ETF, most ETFs, lines have been blurred here. There's actively traded ETFs, but most ETFs say I own this and I'm not going to change it. They don't employ a manager to buy and sell in there because they're just going to buy and hold. If you want to own a whole sector of our economy, you can do that. If you want to own the 500 stocks in the S&P 500, you can buy that ETF. They're not going to buy and sell. You need to control the taxation by investing properly over here, okay? Because every choice you make is going to cause different taxation. We have to understand that. So now you look at these tax classes and say, well, how are we going to use them? That's also going to dictate how we're going to invest this money. Okay. So when we look at this IRA money, well, everything is taxed as ordinary income, and I got to figure out how to get it out at the least amount of taxation possible. So there may be some years I take big chunks and some years I take little chunks, but I'm taking money out of there every single year if I can, period. So that changes how I'm going to invest this part of the portfolio. Roth, everything is tax-free. Well, that alone changes how I invest it. Tax-free income, strategic withdrawals, growth for future. It's a great inflation hedge. Every dollar in there is a full dollar to you. Okay. And so that compounding growth is going to help you keep up with inflation. So for some people, their goal is inflation hedge for later life expenses. Great. Growth mode. Wonderful. I don't have a problem with that. But if we're trying to use this money and not pass it to heirs, tax-free income, that's awesome. That's fantastic. Buying yielding investments that create yield, 4, 5, 6% yield coming out of there that you get to enjoy completely tax-free along the way. And then what I like to call strategic withdrawals, when you're positioned properly, you're going to know when you're going to be able to pull the money from here to avoid higher taxation. If you're bumping right up at the top of the 12% tax bracket, but you needed to buy a car, so you needed an extra $10, $20, $30,000, that's the year you go to the Roth, you dip in and you pull some of the extra money out of there to avoid the higher taxation. That's a strategic withdrawal. Then you've got your after-tax money. Okay, this is where every choice we make is going to come with different tax consequences. So from here, we like the tax advantaged income. We like qualified dividends, long-term capital gains. These are taxed at much lower tax rates. For some people, that's zero taxes if you do it properly. And then we also have emergency withdrawals from here. Okay, so all else fails, maybe we don't have any Roth and we need more than what we can pull from an IRA for tax reasons. Yep, we might have to hit sell on some of those profits and take those out. Okay. So that's how we're going to look at each of this money. IRA, well, first place, we're always going to look at this depending on where we are in the tax brackets at the end of the year. We're going to start by pulling over here because we want to get rid of as much of that IRA money as possible. Think of IRA as like debt. We want to get rid of it as soon as possible, as long as we do it wisely. And then Roth money, we're going to use that to manage the tax brackets, right? We're going to use that as that buffer. And then this after-tax money is the rest. All right. So now applying that to how you're going to invest this money, we need to start looking at that. The first things first, your guaranteed income, you want to control and enjoy your retirement. Have enough guaranteed income to pay your base living expenses. Okay, cover all expected base living expenses with Social Security and pension. People that don't do that, that's when we can start considering income annuities. I see people go buy these income annuities because some slick salesman sold it to them and they had no need for income. It's kind of a dead asset. I always say, look, you're not going to lose your money in this investment, but it's kind of a dead asset. So we got to work our way through it, or we got to do the best we can to use it to our best ability. So it depends on the situation. But if you don't have enough Social Security and pension to pay your base living expenses, okay, now those income annuities become powerful. There's nothing wrong with them when they're used properly. It's the same thing for all annuities. It's the same thing for all investments. We don't have to single out annuities. I know some of you have stigmas about that word. The reality is it earned it in some cases because there's plenty of salespeople just selling it to anybody without their needs being involved. So the next part is have a bank account with 1 year's worth of fund money and a cushion for unexpected expenses, right? You should be able to live a year off these, period. Once a year, you're going to fill this bank account. We're going to talk about that. Controlling the flow is how you're going to control the taxation. So I call this retirement's hierarchy of needs and you. The foundation has to be in place before we worry about all the investing and how we're going to invest the money. The reality is that this foundation isn't solid, everything else will come toppling down. Okay? Enough income to pay your base living expenses, enough cash in the bank to enjoy a year. So whatever your income doesn't pay, whatever you need for the upcoming year, fill that bank account, add a little cushion in there. So that way throughout the year, you're not looking at your investment saying, where should I pull from? Where should I pull from? No, you're just using that bank account all year long. And then once a year, you're going to go in there and fill it back up. Now, your safe investing versus your market investing. And the regulators want me to say safe, stable investing. We all have different ideas of what proper language to use. So safe, stable investing, things like bonds, CDs, investment grade annuity, good annuities, not the garbage that gets sold at dinner seminars, good annuities. And then the stock market investing is the equities, the REITs, MLPs, precious metals. Look, precious metals, I can also call precious metals kind of that emergency store it type thing, but it's expensive to buy and sell. You go buy, GLD, ETF, or things like that. They have volatility. They have liquidity, but they have volatility. So we've got to understand those differences. So your number one priority in retirement is to have a portfolio that gives you the ability to withdraw in good and bad markets without withdrawing from losses. That's only people that need safe investments are ones that are taking money out. If you're just taking money from an IRA and putting it into a Roth account, you're not withdrawing. You're just moving. You don't need a safe investment. I could just take 10 shares of the S&P 500 and move it to my Roth account. It's that easy. It's not hard. But when you go to withdraw, that's the difference. Okay, so the higher your dependence on your portfolio for income, the less it should rely on market performance, meaning the ups and downs and ups and downs. If you're constantly withdrawing, that's going to be a huge problem. Volatility becomes your enemy. So the larger your withdrawal rate, the greater the effect of volatility. We have to understand these principles. Some people need safe investments, some don't. If you have a 1% withdrawal rate, you can have more stock market exposure. If you have a 10% withdrawal rate, you can't afford the fluctuations in the market. So we have to be careful about how we're investing because of those principles. Okay, so everybody's going to have a different mix here, and we're going to prioritize it based on how we're going to use each part of the portfolio, right? The IRA, we know we're going to have to pull from there, okay? And if you're being proactive, you're pulling every single year, so you need more stable investments there. But if you have no need for the money whatsoever because your income's more than covering everything you need, then hey, who cares about safe investments? I'm just going to move the positions from my IRA to my Roth. And now I'm never really selling. Even if I sold and rebought right away, I'm still not really selling. I'm just moving it from this account to the next account. Okay? So now we have to create this income plan and we have to understand the differences in types of income out there. Guaranteed income, pension, Social Security, those income annuities that are guaranteeing payments to you for the rest of your life, those are guaranteed payments. Whether you have savings or not, when the annuity goes to zero, they still keep paying you. Okay, it's not like there's a Social Security account and you're dwindling a cash value and that cash value goes to zero and they stop paying you. That's withdrawing from your savings. You get to zero savings, you get no more money. Okay, that's why guaranteed income is so much better. It's worth a lot more. You can't outlive it. As long as you're alive, that payment keeps coming to you. That is guaranteed income. Now, passive income. Okay, this fluctuates year to year. This should not be needed to pay your electric bill, right? Dividend portfolios. Little more, little less, little more, little less. Every year is a little different, but it's around this area. Things like CDs. I can lock it in for a year, but what are the interest rates next year? It's kind of scary right now because we're on the edge of interest rates coming down and down and down and down. We've got a new Fed chair coming, and the president wants interest rates lower. So we think interest rates will probably come down. You lock in for 1 year, well, 1 year from now, my interest rates might only be 1 or 2%. So you can't call that guaranteed income. It's passive income. It's stuff that fluctuates from year to year. It's the yield from your portfolio. And then there's withdrawal income. Once the yield dries up, that wasn't enough. Now what do I do? Well, you're going to have to sell some of those investments. Withdrawals are different than yield because I can have stocks that pay dividends and I don't have to sell those stocks. So I have just as many shares next year as I had this year, as I had last year. But when I go to withdraw, I have to sell some of those shares. And now next year, I'm going to have less shares, which means I'm going to have less dividends. And that's the snowball effect. So we have to have investments that are better for withdrawal income. Things like when you're taking those required distributions at some point, those are much bigger than the reasonable yield you can create in your IRA. So at some point that gets bigger and bigger and bigger and bigger. And now you got to be ready for those withdrawal income rates. 4.5%, 5%, 6%, 7%, 8%, on up to 9%, 10% on those required distributions. Cars, wake up and need 30, 40, 50 grand is the average price of a car now. Holy cow. Vacations, the big vacations. Sometimes the yield from the portfolio is not enough. We're taking the whole family on the vacation. We're doing the around the world cruise, whatever the case may be. This is the stuff that exceeds the passive and guaranteed income. Okay? Those are the three things we have to be prepared for. Now, go through your basic budget. Need to pays, shelter, health, food, basic enjoyment, debt. Want to pays, vacations, entertainment, hobbies, new cars. Sometimes a new car becomes a need. I get it, but I know people that buy a new car every year, so not needed. That's want. Emergencies, insurance deductibles. Well, there's the car and home repairs. Children are the biggest emergencies I've seen out there. I've seen hundreds of thousands go outdoors. And long-term care. Okay, so we got to think through these things and understand what our individual budget is because every one of you is going to have a different version of this. Now, how are we going to fund this? Well, guaranteed income. I want to make sure that that guaranteed income takes care of the I need to pays. You can survive with no savings. That's what this is all about. Passive income. Okay, that's the dividend yield, the interest payers, all that kind of stuff. That's to supplement this guaranteed income for the I want to pays. You don't want to have to rely on that to pay your electric bill. But it's okay to accumulate them throughout the year and help refill your bank account with them. Because a lot of the times, if done properly, these are going to be the tax advantaged parts of your portfolio. And then the withdrawal income. Well, that's the I want to pays that the passive income didn't cover, and the emergencies. That's when we're going to have to dip in and withdraw. Okay. So we go through that and we say, okay, well, there's stuff we can control and stuff we can't control. And control matters. Social Security, pensions, triggered income annuities. We can't control those. You're not going to call Social Security and say, hey, can you please pay me the less this year so I pay less taxes? You're not going to call any of these and do that. Okay? Can control. Your choice of withdrawing from IRA versus Roth versus after-tax money. Your choices of qualified dividends versus non-qualified dividends versus no dividends at all. Your choices of capital gains, long and short, interest payers, okay, and knowing where to put those. We have to choose these things wisely. So types of taxation, we look at tax advantaged. Well, that's where your qualified dividends and long-term capital gains are. Okay. If you don't know what those are, last month's class, qualified dividends, you got to buy and hold stocks in your after-tax portfolio, and you got to take the dividends that come from those US stocks, and those will end up being qualified dividends, which will be taxed on separate tax brackets. Same thing for long-term capital gains. That's just more than a year. Don't buy and sell, buy and sell, buy and sell. Hold for at least a year. Tax-free, well, that's your Roth withdrawals, municipal bonds, and the after-tax portfolio. Tax deferrable, your IRA is really tax deferred. And you got to remember, tax deferral is not tax-free. It's just I'm not taxed now. Okay, so all the annuity world is included in there, including the variable annuities, the MYGAs, and the fixed indexed annuities. All these annuities are considered tax deferred. So the tax class of IRA is tax deferred and annuities are tax deferred. Now you put an annuity in an IRA, tax deferral in the annuity doesn't do anything. Put it in a Roth, it doesn't do anything. It's all tax free. Put it in your after tax, you only pay taxes on the earnings in the annuity when you pull them out. Tax deferral means something in one category of money, but not in the others. Okay. Full taxation. Well, that's the can't control income, right? Your Social Security, you've got your pension income, those deferred income annuities. IRA withdrawals, full taxation. Interest is full taxation. Short-term capital gains and qualified, sometimes called ordinary dividends, are full taxation. Okay, so we have to look at all of these things and say, how do we put this portfolio together and when? Okay, this is such a puzzle for most people. No matter how clearly I see it when I sit down and go through somebody's situation, it is still a puzzle in most people's minds. Okay, so we have to ground this in reality. These are our tax brackets. Okay, 17,000 is the standard deduction right there. 33,000 for a married couple. You got married over here, you got single over here. This includes the standard deduction, and that's it. Okay, not the bonus deduction, not the new bonus deduction. And 28,000 is the top of the 10%. So from 0 to 17, you pay 0. From 17 to 28, you pay 10. From 28 to 65, you pay 12. From 65 to 120, you pay 22. If I have $66,000 in income, I only pay 22% on 525,000 of it. Okay? We fill one bucket at a time. So when to focus on what? It's real simple. There's a big bold line right here, and here So when we're in low taxation, full taxation is fine. Nobody's going to argue that 10 and 12% is too high of a tax. Now, is there some tweaking for individual situations? This is from 10,000 feet. For most people, full taxation is fine. You want to have some interest payers, you want to make IRA withdrawals, Roth conversions, all that kind of stuff. Pay taxes. Choose to pay taxes when you're in this low taxation. I call this the gray area. Okay. For some people, this is low taxation. But imagine having Social Security and pension income that fills the 12% tax bracket. And now we can choose to have a qualified dividend portfolio and long term capital gains up here because they're going to be taxed at different tax rates. In this case, they're only going to be taxed at 15% when they're up here. Okay, tax-free municipal bonds, maybe withdraw from a Roth if you just had a big year and you need a little extra money in here. You had 65,000 worth of pension and Social Security and you need an extra 20 grand, well, maybe you pull from your Roth. Maybe you pull from some of these qualified dividends and Roth, and now we pay little to no taxation and we're up in these higher tax brackets. We manage the taxation here. And then you hit the red zone. Defer, defer, defer. Yeah, okay. I'm okay passing the taxation to my heirs. They're probably going to pay less taxes anyways. So annuities for deferral, that might be a reason. Minimize withdrawals from IRA, no Roth conversions. Just take only what you have to take, and that's it. Okay? So control the flow to control the taxation. Okay? Controlling the flow is key. Withdraw once a year. Once a year. Once. Stop reaching in every month and taking a little money out. Stop it. Okay? All of your savings is just an extension of your bank account. So you have a checking account, that's where your Social Security, pension, income annuities, that's where they're all paying into. Just like when you had a W-2 paycheck, that W-2 deposited right into your bank account, you pay your bills out of there. You have a savings account. Some of you use your brokerage account and use the money market fund, and that's fine. Just have a savings account. Have a place that money is in cash, money market fund, whatever the case may be. It's easily accessed and moved into your checking. Have 1 year's worth of spending money plus a cushion. Okay? This is an organized way to keep track of and control your taxation. That's why we're doing this once a year. You make much better decisions on where to pull from when you do this once a year. We're going to proactively prepare for the upcoming year. So we're going to typically do this in November. All right? I don't say December because you don't want something to happen and you slip up and you're a little too late on your required distribution. You start doing this in November. You withdraw from safe, stable investments. When the stock market's not doing well, you withdraw from the stock market when it is. So think about it like this. It's real simple. Once a year, you got to go refill that bank account. So I want you to look at all your investments and pull from the best performer. It's that simple. The only reason you have safe, stable investments is so you have some place to pull from when the stock market's not doing well, which means you need to pull from the stock market when it is doing well. Think about it this way. You're locking in the profits. Because we all know locking in losses is what we try to avoid. So then proactively try to lock in profits. So when it comes to refilling the bank account, forget the tax classes right now, because each tax class, I can have some safe investments and some stock market investments. I can have it in my IRA, I can have it in my Roth, I can have it in my after tax. I can if I want to. First things first, control the flow. Once a year, make a smart decision to refill that bank account. If you've got dividends that accumulated in that stock portfolio, those are profits. You can grab those and move them right into your bank account. Lock in those profits. If you have some interest you earn, some yield, and you just want to pull some of that interest, great, those are profits. I'm okay with that. In general, You look for the best investments, the ones that made the most money. You lock in those profits by withdrawing and putting them in your bank account. That's what we're doing once a year. It's that simple. Okay. Now we talk about taxation, right? Because I can have safe and stable investments in every portfolio. I can make that choice. Now, on top of that, I got to make the choice from a taxation standpoint. So it's this simple. Really is, right? Controlling the flow is the key. Withdraw once. It's the same thing, but now we're going to look at these buckets a little differently. Same too. You got a checking account and savings account. We're refilling annually. Here we are in November. We're going to pull from the IRA if we're in lower taxation. So if we're married and we have 65, so this one includes the standard deduction and the new bonus deduction we learned about last month. This one gives you it all. So this is 24,000. This is 47,000 for the standard deduction. That's your zero tax bracket. It's kind of cool. So if we're married and we had 100,000 worth of income, I know I still have 48,000 that will only be taxed at 12%. So I might take an IRA withdrawal to refill my bank account and or do a Roth conversion. Right? Because I want to use all of that 12% tax bracket because that's low taxation. And my kids probably won't pay less than that when they inherit this IRA. And I've got required minimum distributions coming. I want to have less IRA money, so I'm forced to take less out in required minimum distributions. So when I look at these tax brackets, I utilize them when it comes to where I'm choosing to go. If I'm single and I have 74,000 worth of income, then I want to start looking at tax advantage sources. I want to look at my Roth. I want to look at my qualified dividends and my long-term capital gains to avoid this higher taxation. So it depends on where you are. We're looking at this very wisely each year to refill our bank account. Then we get that bank account full. We're that married couple again. We've got 100,000 worth of income. I filled my bank account. I've got a whole $100,000. I had 60,000 in pension and Social Security, and I pulled 40,000 to refill my bank account. I'm now at $100,000 worth of income. I still have room for 48 more. I'm going to do my Roth conversion. I'm going to pull 40 from my IRA. Okay, so that's where we go with our year-end maintenance. Charitable giving. Every year in November, we're refilling that bank account. We got to decide what we're doing with all this. If you're over 70 and a half, you got QCDs, qualified charitable distributions. All charitable giving should be coming directly from your IRA. It should be what you're doing, period. So when you're looking at your required distribution, you're saying, oh, I got to pull $10,000. I need 5 of it to refill my bank account. I'm going to give the other 5 to my church. Great, done. You'll only pay taxes on the 5 you took. And you satisfied your required minimum distribution because you pulled the full 10 out. There's some fun things you can do by bundling up 2 years into one, and you end up rotating years. There's some fun things you could do. There's plenty of Arizona tax credits if you live here in Arizona. There's lots of fun things you can do on charitable giving. Tax loss harvesting. If you've got a big after-tax portfolio, you got to take a look at this every year towards the end of the year. So in this once-a-year maintenance, we're going to do this. We're going to refill the bank account. We're going to look at this too. You can look at all those after-tax investments. If you have any investments with losses on it, you can sell those. My example is $13,000 position, a position that was down $13,000. I can sell that position. Then I can go sell gains of $10,000, leaving me $3,000, which is the maximum we're allowed to use against ordinary income. So we essentially did a wash sale. We sold 10,000 worth of losses, sold 10,000 worth of gains. There's no taxation. We sold an additional 3,000 of losses so we could capitalize on the higher taxation of ordinary income. We do that in our portfolio every year. We're going to minimize the taxation when it comes time that we actually need it. All right. Retirement contributions. End of the year, this is the other consideration. 2026, you must have earned income, but you can make deposits into IRA and Roth. If you have any earned income, you can do it. Even for a spouse that did not work. So if one of you is a marshal on a golf course and makes 17, 18, 17,000, you could do 8,500 each. Okay. So as long as there's earned income on the tax return, you can make contributions. If you're in high taxation, you deposit it into IRA so we can avoid taxation now. If you're in low taxation, you deposit into Roth. Withdraw your required distribution. Obviously, if you're of age right now, if you're over 73, you have required minimum distributions. And if you forget, the penalty is 25% for failure to taking it. It used to be 50. I think they're going to start enforcing it because they lowered it. Roth conversions. Okay, so once we've refilled our bank account, once we've done our charitable giving, now we got to see what's left over. If we have room in the lower tax brackets, then absolutely let's start converting. Choosing and controlling the tax rates we're paying on that IRA savings is one of the reasons we do this. Avoiding or reducing required minimum distributions. That's why we do this. We're being proactive. Hedging against higher taxes. How many people think the taxes are going to be higher in the future, whether it's 5, 10, 15, 20 years from now? Are they going to be higher? Are they going to be higher when your kids inherit the money? Avoiding IRMA. Well, be careful about your required distribution, be careful about how much you're converting to Roth because that's calculated in this IRMA. But IRMA, your adjustment to your Medicare premium, if RMDs push you above it, oh, that's not fun. Okay. Reduce taxes passed to heirs. Increase control over taxation in retirement and take advantage of a down market or position. I'll tell you, if the market had just crashed 40%, I'm going to get a lot more aggressive in converting to Roth because each individual share is worth less and I can move it over and get taxed less because it's less value. And now all of a sudden it grows right back. The pandemic was the perfect time to get aggressive in Roth conversions for sure. All right, so that's a lot of reasons to convert to Roth. How do we do this? How do we calculate this? Well, if you want to max out the top of the 12% tax bracket, you start with the IRS number of $100,800. That's the maximum in the 12% tax bracket. For a married couple, it's $50,400 for a single person. Then you add your standard deductions, including the new bonus deduction. Holy cow, look at all these. This is so much to deduct now. Okay, so we look at this stuff and we say, okay, we got a lot of stuff we can deduct. So that gives us a much bigger number to work with. So for married couples, if you qualify for that bonus deduction, you got 148,000, and single people with that bonus deduction, 74,000. We start with that number, we subtract out all other forms of income. Okay, so 85% of your Social Security is the maximum that your Social Security can get taxed. You subtract your pension, you subtract any interest income, and any other income, including those qualified dividends and long-term capital gains. And what you're left with is how much money you can convert to IRA. So it's real simple. So I go back to that same married scenario. If you had 100,000 worth of income, you got room for $48,000 to convert to IRA at 12%. Single people, if you had 50,000 worth of income, you got room for 14,000 to convert to IRA. Everybody's going to look at these tax brackets differently. Okay, 65 plus with standard deduction and bonus deduction. These are your maximums. Look at all these. So for married couples, it's 148, it's 74,000 for single. If you want to fill the 22, you got to start worrying about IRMA. Towards the end of filling this, you're going to hit IRMA. But 258,000 for married, 129 for single, 24%, 32, 35, 37. You can see how those work. Okay. Your heirs. First of all, estate taxes. Some of you worry about estate taxes, but shouldn't be. So if you have less than 15 million each, So if you're married, yes, that's 30 million. You don't really have to worry about federal estate taxes. You're allowed to gift 19,000 a year. If you gift more, there's no taxation. No, nobody throws you in jail. Everything's fine. You just have to reduce your lifetime exemption. But if you owe state estate taxes, the feds will deduct it dollar for dollar. State estate taxes, you say? Well, we don't have them in Arizona, so those of you that live here in Arizona, you don't have to worry about them. We like our retirees. These are the rest of the states. Although Iowa is going to go away now, they've officially repealed all of their estate taxes and inheritance taxes. All these other states have not. They have them, and Oregon just updated and went down. You don't see down very often. Now, what dictates this taxation? Well, if they can say it's your primary residence. My uncle lives in Oregon. I used to live in Oregon. Um, $1 million, that's ridiculous at this point. We're at 15 million federally. Well, Oregon's broke. So they need money. So every estate, when they pass away, if it's your primary residence, because the address on your tax return says it is, or your driver's license says it is, then they're going to go after your entire estate and tax everything over $1 million, anywhere from 10 to 16%. Okay? So you can owe state estate taxes, but not owe federal estate taxes. That's the lesson on this. So just understand some of these states, you got to be a little more careful than others, especially states like Maryland that have both an inheritance tax law and an estate tax law. What's the difference? Well, they get to write their own rules. It's each individual portion that you send out that the inheritance tax is looking at, whereas the estate tax is looking at the entire value of the whole estate. If it's not your primary residence, let's just say I had a second home in Oregon or a rental property in Oregon, then they can only tax what's in the state. So if the house is worth $2 million, yeah, they're still going to tax me, but they can only tax what's in their state. They can't go tax my investments that are not in their state. All right, it's easy. If you're in any of those states, just get out. That's how you control this taxation. I have a lot of clients in Illinois. A lot of people from Chicago love Arizona, and so we have to work through some of that. I have several clients from Washington State, and Washington's down to 3 million, and they just put a lot of restrictions on there, not portable, a bunch of other problems that they've added. So there are states out there. Minnesota's 3 million as well. So you got to watch some of this. So now, what about your heirs? Well, the first thing is how many heirs, right? Cutting an IRA into 10 pieces means much smaller chunks for each. That's just the reality of it. Are you going to pay less taxation, or are 10 of your heirs split up 10 ways going to pay less taxation? That question starts becoming a little more apparent in some people's situations. So sometimes passing the taxation to your heirs is a good idea, but if you have one heir and that heir ends up being successful, they may pay a tremendous amount more in taxation because they've got to push all that IRA out in 10 years. So there's that distribution rule, okay? If your spouse or a minor child or chronically ill or disabled, so the beneficiary of your IRA or Roth for that matter, is a spouse, a minor child, chronically ill or disabled, or not more than 10 years younger than the original owner. Yes, that's how difficult these rules are getting. Give it to your brother who's 9 years and they have a separate set of rules. You have different set of choices. Okay, so those people have different rules. Minors, spouses, chronically ill or disabled, not more than 10 years younger than the original owner. They've got fun rules. Everybody else, look, you've got 10 years to get this money out. And if the original owner was of required minimum distribution age, then the heir has to take the required distribution. If not, you see how difficult this is getting? This is scary. I just be honest. I can't look. All these changes and rules give a reason for my existence. I can't tell you, I'd say a handful of times a year I have heirs in my office trying to figure out how to handle this. The heirs universally have no idea what they're doing when they inherit the IRA. And with no advice, they're just going to cash it out. That's what they're going to do. And they're going to pay a tremendous amount of taxes on it. So, this is kind of the way I look at it. I sit down with the heirs and I talk about their situation to get to know them. Are they still working? Are they planning on retiring? What age are they? How much longer are they going to work? What kind of income do they have? We got to figure all this out to create a plan. You got 10 years to get this money out. Let's outline a plan that's going to pay the least amount of taxes. At minimum, we can just start with pulling 1/10 out every single year. We look at the tax brackets and we decide what's best for those people. If you're not over 65, you don't have as big as standard deductions, which means you don't have as much room in that 12% world. So we have to work with this individually and create that plan. And that's what's important, is that there is a plan. Okay. Guidance is important. So make sure your financial advisor understands your whole situation and pays attention to the taxation they cause. You're investing in your after-tax part of your portfolio is completely different than your IRA and Roth. I hope that's apparent. Maximize your 12% tax bracket between 59.5 and 73. This helps you avoid the excessive taxation once you hit that required distribution phase. All I'm talking about is just being proactive, choosing that taxation that you're paying on that IRA. If you're charitable and over 70.5, please only give from your IRA. Please, please, please. It's so much more efficient on your tax return. Think about your heirs' tax brackets when they inherit it. Okay, that's another thing that comes into the equation. I know people that were pushing as much money aggressively into the 20+% tax brackets into Roth, and they were going to have 10 kids splitting all this money. And that's why I brought the 10 kids up. And I'm looking at them going, why are you doing this? Your kids are going to pay a lot less taxes on this than what you're paying. And they're like, oh, that doesn't make any sense. And systemize this year-end review. Give yourself choices. Look at those 3 different tax classes. Pull from the best performers. Fill the 12% tax bracket with IRA money if you can. All right, then start utilizing the Roth properly, the after-tax money. That's tax advantaged when you invest that properly. Systemize this so once a year you can sit down and pull the profits, fill that bank account. Now let's follow all those other things we got to do. We got to do Roth conversions after that. We got to do our charitable giving. We got to do tax loss harvesting. We got to look at all the little tweaks that we can do to help your situation year to year to year. Tax planning is not, here's your plan. It's every single year being able to make the decisions. And that's why positioning your portfolio properly so you have the flexibility to manage this properly, that becomes the key. So, achieve balance. Okay? If you go into retirement and only have IRA money, you got a lot of work to do. And a lot of people enter retirement and all they have is IRA. We got to start getting proactive and get that IRA money out and get yourself some Roth money and some after-tax money so we have choices later on. If we only have the choice to pull from IRA, then you only have the choice to pay the taxes, and that's it. Choose the right investments for you. I use Hershey's versus Coke. One stock is using their profits to buy them back, meaning there's less shares, which means each share is worth more. We're building capital gains without any taxable events. Whereas the other one chooses to pay out the profits in the form of dividends. Well, if I need dividends to refill my bank account and they're tax advantage for me, then great, that's wonderful. But if I didn't need that taxation, then that's less Roth converting I can do. So we want to minimize the dividends for people that don't need that income. Capital gains versus dividends, corporate bonds versus municipal bonds. We got to make sure we have the right investments for our situation. Choose the right investments for the right type of money. For instance, IRA. For most people, I know I'm going to have to pull at least a little bit of money every single year from there. So I need to have some stable choices in there so I'm not pulling from losses, right? The after-tax money. Well, there I need to make sure it's tax advantaged. We're focusing on U.S. investments, U.S. stocks, paying qualified dividends, or being in more of a growth structure and minimizing the dividends. Everybody's going to be different. Create that income plan that covers your bills. Pay attention to your budget. If you're feeling uncomfortable in retirement, the first place I look is, does your income, your guaranteed income, pay that base living expense? That's quite often what makes people feel uncomfortable in retirement. Manage your losses. The little tweaking you can do at the end of every single year is going to help in the big picture. If you do nothing, which I've watched lots of people just do nothing, and they got all these huge capital gains in there, and they're like, I don't want to touch it now. Every dollar I take out of there, I got to pay taxes on. Well, you could have been proactive along the way and had much less there. Okay. All right. So, good advisors, yeah, they're doing that stuff. They should be doing that stuff if it's pertinent to your situation. Remember, retirement planning is not just investing your money, right? When you're in your wealth building years, your working years, put your head down, make money, spend less than you make and save the difference. I mean, it is just about investing your money. But when you start transitioning into retirement and in those retirement years, this is where advisors need to earn their keep. You're paying them fees. They should be doing things like all of this to save you way more money than they're charging you. That's the point. That's the point of making you as efficient as possible. So be honest about where you are and where you want to be. Set goals, educate yourself, develop a strategy, inspect what you expect, and consult with knowledgeable, unbiased advisors. Public Zoom schedule, yay! So April's class, navigating safe investments in today's market. So I review anything that's considered safe, stable investments out there. We'll talk about bonds, we'll talk about annuities, we'll talk about CDs, treasuries, all that stuff. So we'll go through all those different types of safe investments in that class. And then we'll also talk about who needs them and why, right? Because not everybody needs safe investments. So public Zoom schedule, jump on fpfeaz.org, our nonprofit website. I'll put that up in the next slide there. So first Tuesdays, second Saturdays, second Wednesdays, third Thursdays. And as of this point, I'm still doing the Q&As, but if people don't start coming with questions, I'm going to stop doing them and I'm just going to play the class. Inevitably, half the people that are on there were just there to watch the class. The other half have maybe one question, and that's about it. So come with questions. That's the whole idea of the last Monday of every month. Come with questions. Don't forget, there's a little questionnaire at the end of this if you need anything from me. You can always shoot us an email or give us a call. YouTube, there it is, Planning Before Investing. Go find that channel, subscribe. I'm putting new videos on all the time. fpfeaz.org, full class schedule, lots of great stuff on there. sesweb.net, you can schedule a free meet and greet appointment with me. Give us a call. You can also view all of our education resources on there as well. I hope that helps. If you come to our classes in person, I teach them here in Scottsdale. There's lots of wonderful classes. You get to fill out a wonderful evaluation. Instead, I've got the questions that are coming up here. So thanks for attending. And yeah, I appreciate it. We'll see you soon. Have a good one, guys. Thank you. Bye.